A company is selling 499 units of their product. Revenue is coming in, costs are covered, or so they think. But when we run the numbers, they're still losing money. How is that even possible? And more importantly, how does Oracle Planning tell you exactly when that loss turns into profit? That's what we're solving today. In this video, we're building a complete break-even and CVP analysis model inside Oracle EPBCS. CVP, cost volume profit, is one of the most powerful financial analysis frameworks in business. And today, we're going to automate the entire thing using an Essbase calc script. By the end of this video, you'll know the break-even point, the PV ratio, the margin of safety, and exactly how many units your company needs to sell to hit a desired profit, all calculated automatically in planning.
Let's set the scene. A company sells a single product, a pen. The selling price is 100 points per unit. Variable cost, the cost that changes with every unit produced, is $80 per unit. Fixed cost, the cost that stays the same regardless of how many units are sold, is $10,000. Now, the business wants answers to 5 critical questions. 1. At what sales quantity does profit become 0? That's the break-even point. 2. What is the profit at 499 units? At 500? At 750? 3. How many units are needed to achieve a desired profit? 4. What is the profit volume ratio? And 5. What is the margin of safety? 5 questions, 1 calc script. Let's build the logic. Before we touch the code, let's understand what each of these metrics actually means. First, my sales. This is simply selling price per unit multiplied by units sold. At 500 units, that's 100 rupees times 500. My sales equals 50,000 rupees. Next, variable cost. Variable cost per unit multiplied by units sold. At 500 units, 80 rupees times 500, variable cost is 40,000 rupees. Now, contribution. This is the heart of marginal costing. Contribution equals my sales minus variable cost. At 500 units, 50,000 rupees minus 40,000 rupees. Contribution is 10,000 rupees. This 10,000 rupees goes first toward covering fixed cost. Whatever remains after that is profit. So profit equals contribution minus fixed cost. At 500 units, 10,000 rupees minus 10,000 rupees, profit is exactly 0. That is your break-even point, 500 units. Now you understand why 499 units gives a loss of 20 rupees, 1 unit short of break-even. The numbers don't lie. Next, PV ratio, profit volume ratio. This tells you for every 1 rupee of sales, how much goes toward contribution. Formula, contribution divided by sales multiplied by 100. At 500 units, 10,000 rupees divided by 50,000 rupees, PV ratio is 20%. Break-even units, fixed cost divided by contribution per unit. 10,000 rupees divided by 20 rupees, break-even is 500 units. Break-even sales, simply break-even units multiplied by selling price. 500 times 100 rupees, break-even sales is 50,000 rupees. Required units, this answers the question, how many units to achieve a desired profit? Formula, fixed cost plus desired profit divided by contribution per unit. With desired profit of 5,000 rupees, that's 15,000 rupees divided by 20 rupees, you need 750 units. Finally, margin of safety. This tells you how far above break-even you currently are. In units, actual units sold minus break-even units. In value, actual sales minus break-even sales. At 750 units, margin of safety is 250 units or 25,000 rupees. At 499 units, it's minus 1 unit and minus 100 rupees. You're in the danger zone. 8 metrics, all connected, all flowing from 4 simple inputs. Here is the complete calc script. Let's walk through every line. We open with the fixed statement. This scopes the calculation to 3 specific dimension members: forecast scenario, working version, and sales US entity. Only data matching all three conditions will be calculated. Line 1, my sales. Selling price per unit multiplied by units sold. This is your top line, total revenue from the product. Line 2, variable cost. Variable cost per unit multiplied by units sold. This scales directly with volume. More units, higher variable cost. Line 3, contribution. Sales minus variable cost. This is the amount available to cover fixed cost and generate profit. This is the core of marginal costing. Line 4, profit. Contribution minus fixed cost. Positive, you're profitable. 0, you're at break even. Negative, you're in loss. At 499 units, profit is minus 20 rupees. At 500 units, exactly 0. 1 unit, 20 rupees. That's how thin the margin can be. Line 5, PV ratio. Contribution divided by sales multiplied by 100. Expressed as a percentage, this tells management the profitability efficiency of every sale. Line 6, contribution per unit. Selling price minus variable cost. At the unit level. This is $100 minus $80. Contribution per unit is 20 rupees. Line 7 and 8, break even. Break even units, fixed cost divided by contribution per unit. $10,000 divided by 20 rupees. 500 units. Break even sales, those 500 units multiplied by selling price. 500 times $100, $50,000. That's the revenue you need just to break even. Line 9, required units for desired profit. Fixed cost plus desired profit, divided by contribution per unit. The bracket here is critical. It ensures fixed cost and desired profit are summed first. With desired profit of $5,000, that's $15,000. Divided by 20 rupees, you need 750 units. Lines 10 and 11, margin of safety. Units sold minus break-even units. Your safety cushion in units. My sales minus break-even sales. Your safety cushion in revenue. At 750 units, that's 250 units, or $25,000 above break-even. At 499 units, it's minus 1 unit and minus $100. You're in the danger zone. And we close with end fix. Every fix block must be closed, always.
Now let's look at the actual SmartView output from Oracle Planning across 4 time periods: Jan, Feb, March, April. In January, 750 units sold. Profit is 5,000 rupees. Margin of safety is 250 units. Healthy. In February, 500 units. Profit is exactly 0, right at break even. In March, 499 units. Profit drops to minus $20. In April, 700 units sold. But notice, break-even units shows missing. Why? Because April has no product dimension assigned. It's the no product 1 scenario. The script runs correctly. It simply has no base data to calculate against. The numbers match exactly what our logic predicted. That's the power of automating CVP analysis in EPBCS. And that's it. We started with one uncomfortable question. Why is a company losing money at 499 units? And we answered it completely with a single Essbase calc script. Here's what we covered today. The complete CVP analysis framework, 8 interconnected metrics, real financial logic, contribution, break-even, PV ratio, margin of safety. Every line of the calc script explained clearly. Live SmartView output, real numbers, real proof. If this video added value, hit like. It genuinely helps this channel reach more EPM professionals. Comment below. Tell me what financial model or Oracle EPM use case you want automated next. And if you're not subscribed yet, do it now. Because every week, we take real Oracle EPM problems and break them down in the simplest way possible. See you in the next one.